And so it goes on, and we passed the 1-year anniversary of lockdown. And we're starting to see things generally looking up. I really wanted to cover the 3 scenarios that are getting discussed so much in our house. My parents who are most concerned about saving and pensions, and my friends who are most concerned about saving and investing, whether it's in property or not.
What sort of stupid question is that? Are you blind?
So the general backdrop of the UK is looking good, I think. Our Bank of England thinks the economy will recover fast despite being hit with the worst economic disaster for 300 years. And we should return to pre-pandemic levels by 2022. And as we talked about in my previous video, this will have a knock-on impact on our spirits because we'll start paying down that balance sheet we've built up. Also because we've not been able to spend in restaurants and holidays.
We're all going on a summer holiday.
So forget coronavirus, that was so 2020. 2021 and 22 is all about inflation woes, and so we need to get savvy to protect ourselves against inflation. The pandemic itself has been crippling and delivered some knockout punches, but it's also delivered some pleasant surprises. How do we protect our savings, continue to build our pensions, and build buy-to-let investments? So for all you savers out there, now millions have struggled through the pandemic and lockdown, though there are others that have prospered. A year ago when the Prime Minister did order the lockdown, people were locked in to prevent the spread of the virus. Those on universal credit have doubled to 6 million people, and it's approaching 10% of the population. That's pretty insane if you ask me.
Wow, I thought you'd be a little more shocked.
Unemployment is continued to rise and hit 6.5% this year, and it currently sits at 5.6%. Companies, they will still continue to go bust, and workforces are being laid off with it. However, there are those that are way better off too. Households have put aside £160 billion in savings accounts since last March, which equates to about 14.5 billion a month through the pandemic. And is that high? Yes, it's very high, because pre-pandemic levels of savings were only £5 billion per month. So the number of households putting away money is almost 3 times what they did in the past. At the same time, saving rates have dropped to their lowest level since 2009. It's a cliff edge, guys. Families earn just 0.4% and many earn nothing at all, so protecting the buying of our cash has never been harder. So what are the options and what can we do? Firstly, reminding ourselves that cash savings are for emergencies and figuring out how much we need to put away for emergencies. This would typically be about 3 to 6 months of your expenditure, and so not holding excessive cash beyond that. Cash beyond that should be invested, and we need to get savvier on how to do that. The slow burning flame on your cash is the savings rate, the inflation rate. This is how much your cash is losing each year in terms of its purchasing power. There are better options for cash, and for those that pay 1.3% a year, but you do have to tie your cash up for a longer period of time, up to 5 years in some cases, which actually defeats the point of an emergency fund.
You know something? You're right.
The other option that UK YouTubers are discussing are premium bonds. It is a nice idea because you have the potential to win £1 million and then forget the emergency budget. What emergency budget? Actually, the effective interest rate is closer to 1% and savings are limited to 50k. Over the years, I have moved away most of my investments and savings away from Hargreaves Lansdowne. They're expensive, but then I am a fan of the Savings Hub as well, so it's a bit of a dilemma. One of the things I love about it is there is an aggregator of various savings accounts, and so you have a choice of saving products in the hub. It's quite nifty and really easy to use. Now, I love discussing pension investing. It's the most efficient way to invest for retirement, and despite all the clampdowns, there are some huge tax advantages. But the question is, what has the pandemic done to pension investing? Well, I have to tell you, it's a through-the-middle split. Almost 1.5 million people will have to delay their retirement for more than 3 years because the pension pots were decimated in the pandemic blip. However, 1 million others now plan to retire earlier because they've been able to save more through the lockdowns and invest more as well. So state pensions will rise this year in what we call a triple lock. This is where the payments rise in line with the highest of inflation, wage increases, or a minimum of 2.5%. And those lucky to have those final salary pensions will have their pensions rise in line with inflation as well.
Rightfully so.
I think for us, the stark reminder is that modern private workplace pensions are not linked to our wages directly and are simply dependent on the markets and what we invest in. when times do get tough, we can reduce our pension contributions, but we should remember to increase them back as we return to normal. It is a real issue that we need to open our eyes to, because 10% of people have reduced their contributions and 6% have stopped altogether, and that's quite concerning. Stopping these contributions or taking breaks has a huge, massive impact on retirement income in the long run.
Okay, and what do you want me to do about that?
Those who do watch this channel quite regularly will know that markets tend to overshoot all the time. It's part and parcel of investing, and markets in developed economies have recovered well, and in some cases on a tear over the last 12 months. And the S&P 500 is up 20%, and the UK, while lagging, is now getting back to flat. But even that may not last for as long as there is more and more press and analysis pointing at how cheap UK companies are, where investors were simply dumping stocks as dividends were being suspended.
Peekaboo.
But what do we do then? Well, the key is a selection of a mixed bag of funds that invest across the world is the obvious way to go. It's all about diversification and spreading your money across lots of companies and markets. That way you're aligned to the prosperity of the world and not taking on the burden of picking something yourself. If you're interested in how I do it, well, I for the most part buy blended funds from Vanguard, which is one fund that owns quite a few other Vanguard funds to automatically diversify your holdings. It's quite good like that. And you can pick a fund that's right for you. If you are a long way away from retirement, you pick the funds that have a higher equity portion, and the closer you are to retiring, you can pick funds that contain more bonds. So it's pretty flexible, adaptable, reputable even. Guys, I'm not being sponsored. I wish I was though, because I'm a huge Vanguard fan. So what about buy-to-let investing then? Well, as you know, I am a buy-to-let investor myself, so I track the market pretty closely and have been impacted as time goes on. For me, rents have declined, and London, where we typically take the market for granted because it's a vibrant market and rentals are easy to put up, well, that's no longer the case. Rents are negotiated lower, so income has taken a hit, but I've also been lucky that my rentals have continued, albeit some at lower levels.
And that pisses me off.
That feedback mirrors what the market is showing. So about 50% of landlords have reported an increase in earnings, and the majority of those are outside of London. However, rents in the capital have fallen by about 20%. On the other side of the equation, we are also home and property owners. And so where rents may have fallen, property prices have benefited from a pandemic house price boom, guys. Average property prices increasing by about 8.5%. And house prices look like they will continue to rise as data sites and property websites like rightmove.com keep pointing out the fact that it's a seller's market, which means there is a lack of supply, which pushes up prices. As a Londoner though, well, not so good. House prices in the capital are about 3.5% higher. However, in the northwest, house prices grew the fastest and ended 2020 about 12% up. That's madness. The same with rental yields too, where best yields are in the northeast. Places like Hartlepool have a yield of 8.3%, and it's mirrored in areas like Newcastle and Sunderland. London is the worst, with yields of only around 3%.
Let me pretend I care. Okay, I'm done.
The final point to mention is stamp duty, and we talked about stamp duty quite a bit earlier this year, but the government has kicked the can down the road with stamp duty being tapered off in June and then reverting back to the normal rates by September this year. I still think that the impact this will have on the property market is the same as we discussed before. It's a literal kicking the can down the road.
My God, are you always on?
So I have linked that video right here, and like we also said, inflation is a slow burning flame and has not been a problem for 40 years, but it is now, guys. So if you want to understand why it's important and why it's a problem, then also click here so you can make better investing decisions through a more inflationary environment. It's not that complicated, guys, so I'll see you over there.